Though I will say we didn't close under the implied move for the day for a change. We did get a pretty good test down at that 65.75 level. Obviously, the incentive to sell puts there was very high. So we got a nice couple of bounces. We got one off the 6600 level, 65.75. But that positioning taking profits still short dated, not a lot of confidence, right? So these aren't long dated puts coming in. They're heavily incentivized short dated puts that are being sold because the VRP on the zero DT is fucking ridiculous, right? Like so much positive carry that everyone just wants to sell the fuck out of those puts. Anyway, so some of those ended up closing out the day safe, but a lot didn't, right? The attempted bounces off of 66.40, 66.50, those failed. Those puts collapsed, so we got a bit of a vol spike into close, leaving volatility elevated over the entirety of the day and continuing our downtrend for this week into tomorrow's data. We actually have data tomorrow. So if we're going to expect any mean reversion out of bulls, it'll probably come tomorrow, prior to the FOMC data. If it doesn't, well, there's Thursday, but we'll see. Um, Obviously, over here on ES, we had an inverse head and shoulders setup on the 1 hour that just failed. With this drop below close, so we still have 6600 to the downside open as an important level, and then 6579, 6540 below that, 4030 below that. So those are also going to be fairly important tests. This range pretty decent. This one a little tighter between support levels. Yields at the top end of the curve didn't hold a lot of their gains today, but it seems that some demand has been returning at the 2 and the 5, and the dollar still moving up. Correlation almost stabilized in the intraday and then broke down again into close, hitting a new high into end of day for the 1 month correlation, but 3 month correlation slightly lower high into close, although it's still increasing. I mean, it looks like dispersion's still having a hard time getting a foothold. And the last time, last week they tried to turn things around and they got blown up. And this looks like it's setting up a very similar leg down. Um, Commodities doing a little bit better today. Silver climbing, gold stabilizing above 4,000. We see agricultural commodities move up and oil back above $60 a barrel as the House moves closer to passing a resolution on Russian sanctions. Not a lot of move and not a lot of move in move in bond volatility, but 3 month correlations continuing to rise. So I would expect we'll see bond volatility catch up to that. Leverage on the carry trade still pushing higher. Remember these levels significantly over the 2008 highs and even over recent highs. So leverage into the carry trade is growing at a pretty significant pace between the US dollar and the yen. And some of that being realized on the short end, but short end leverage is still fairly low. Forward yield on volatility is continuing to march higher though. Moved up from yesterday's close at like 6% to almost 12% at close today. So not only is this incentivizing people to go longer and longer volatility, but it's ensuring that there's a very good yield to capture there, and that'll help hedge any risk off from equities into bonds. That's part of the demand that drives that up. Skew still chopping around. I guess things got a little bit better today, but probably worse by end of day. 20-day movers still, I don't know, 20-day movers finally surpassing 50-day declines. And so we are starting to get some momentum to the downside. We'll see if this continues. Usually you'll see your 20-day percentage of 20-day movers significantly below stocks above their 50-day moving average before you see any kind of turnaround, as like we saw back here in July, August, or back here, in April, when we had the big sell-off. Usually those don't drop at the same rate. They are dropping at very similar rates right now, but I think more importantly, stocks above their 200-day moving average on the S&P 500 is now 49%. So the index overall, the majority of the index overall is below its 200-day moving average. So these sell-offs are pretty broad. Correlation starting to still flattening, I think, a little. We got barely any change day over day, flattening, but volatility starting to turn up. And as correlation starts to turn around and people give up on shorting volatility, we can start to see volatility climb even more. This period of vol shorting has not been very productive for vol sellers, and they're starting to get squeezed out of those positions. Fed fund futures, no real change. The 10-2 moving up a little bit, closer to a recessionary signal. The SOFR moved up to 4%, so we got a 10 basis point spread there over IORB. Cash demand should continue to pick up into the end of this week as we approach OPEX, and at least into the SLD period, where supplemental liquidity deposits need to be made. Cash will be important, so we may see SOFR rise again over that, SRF and IORB rates, and the spread get even wider. And that's where we get that liquidity crunch on the front end. Right now, things are kind of managed. We had a lot of up volume today, although it didn't produce very good returns. And SPX and leverage continue to decline in tandem with one another, which is also bearish. So leverage is pulling back as the index is selling off. We got a test of the 6,600 level, which is very important. We got a bounce off of it, but a weak one. And so that does open up downside continuation. Obviously, 6,600 is kind of going to be the confirm there. There's a little bit of historic support around 6,550. That's of some importance. I believe that's a monthly low. Is that October low, like 6,550? So slipping below that does confirm that we have rejected from all-time highs, then we're getting a correction. But watch for stability here along the 2022 bull market trend, because there could still be buyers in this range, and if we find enough buyers between 6,550, 6,600, I would expect some kind of capitulation rally that could carry us back up, maybe fill some of the upside gaps, maybe like 6,700s. Anything that fell below that would be really fucking bad, but maybe like 67, 64-ish, something like that. Yeah, I think that's about it. Everything pretty much selling off broadly. Health technology is still doing pretty well, and consumer non-durables. So we are still seeing a rotation to defensives a bit. However, health services not doing that great. Producer manufacturing surprisingly not doing very well during all of this. Partially probably because retail trade is still pretty bad. Consumer durables underperforming, but tech continuing to just sell off. I guess financials are kind of stable, not really up or down. And then yeah, that's about it. So thank you guys so much for tuning in. I hope you all made some money today, and I will see you tomorrow. Later.